Tattlebaum. We are moments away from the Bank of England's latest interest rate decision. The central bank is expected to keep rates on hold, with investors looking for any clues in its statement on the future path as tariffs and global uncertainty cloud the outlook. Let's kick off with a look at how markets are faring ahead of this decision. We are looking at a little bit of weakness in sterling versus the dollar. Sterling down about 1/3% versus the greenback, just under the 130 level. In terms of gilt markets, let's take a look at where things stand in the bond market. We are looking, let's take a look at the curve. We've got the 2-year trading around 4.15%, the 10-year gilt yield just over the 4.5% mark. Now, of course, this Bank of England decision certainly a focal point for investors, but so is the UK budget. On March 26th, Chancellor Reeves will deliver an update of the public finances and the economic outlook. So yes, the monetary policy outlook is important here, but the fiscal outlook is also incredibly important. Let's take a look at the stock market. FTSE 100 this morning is trading lower by about 16 basis points, just over 8,600. This is in line with the broader European market. The Stock 600 this morning is having a down day. It's down about 0.6%. You can put it in context there. FTSE 100 down 17 basis points, but the main benchmark down about 64 basis points. You're seeing outsized losses right now in the Italian market. FTSE MIB down about 1.4%. The Xetra DAX down about 1.4 as well. Now, looking at dollar crosses, here's a picture. You've got sterling, as you saw, trading lower versus the dollar. The euro dollar also trading on the back foot. The Swiss franc also in focus this morning. Switzerland's central bank cut its benchmark rate by 25 basis points, lowering it to 0.25%, a fifth successive cut. Now, while markets do not see the S&P cutting rates into negative territory, Chairman Martin Schlegel said the bank would be ready to intervene in the currency market if necessary. Meanwhile, the Riksbank kept its policy rate on hold at 2.25% as expected. Sweden's central bank stuck to its guidance, saying it sees no changes ahead as it balances the risks of sluggish demand and rising trade tensions. Well, now it's time for the Bank of England decision for them to weigh in. They have maintained the bank rate at 4.5% as expected. The market was not looking for any change in policy today. The MPC voted by a majority of 8-1 to maintain the bank rate at 5.1%. The policy statement, they've kept the phrase "a gradual and careful approach to removing policy restraint remains appropriate." So that language was key. The no presumption monetary policy is on a preset path over the next few meetings. Governor Andrew Bailey saying that there is a lot of economic uncertainty at the moment. We still think that interest rates are on a gradually declining path. Now, the investment community has taken this to mean a gradual approach to cutting rates, to mean that they are likely to cut rates once per quarter. In terms of the inflation expectations, we're looking at inflation peaking at 3.75% in Q3 of this year. The February forecast was for 3.7%, so they have raised that inflation peak expectation slightly. Swati Dhingra was the one who voted to cut rates by 0.25 percentage points, so that was the one dissent in that 8-1 distribution. Global trade policy has intensified, the MPC says. Other geopolitical uncertainties have also increased. The MPC will pay close attention to any consequent signs of more lasting inflation pressure. GDP has been slightly stronger than expected in February. Surveys suggest weak growth and especially employment plans. Monetary policy will need to continue to remain restrictive for sufficiently long. So those are some key lines out of the Bank of England. Sterling has slightly trimmed losses after the decision. You can see right now sterling down about a 0.25%. We were down more than 0.3% before the decision came through. So some bidding back of sterling versus the dollar. We're still under the 130 mark, however. Looking at the gilt market, let's take a look at where yields stand right now. You've got the 10-year still hovering around 4.57% or so, so not a lot of movement there as the Bank of England holds rates steady. Let's push on and take a look at the FTSE 100. What's going on in equity markets? You've got the FTSE down about 0.25%, so a little bit steeper, and that moves in lockstep with the slight bounce we've seen in sterling, or the retracing of some of those steeper losses. So FTSE 100 a little bit weaker now after this decision and the impact it's had on sterling. Looking at the UK banks in a little bit more detail, here's the picture. You've got Barclays down about 1.4% today. NatWest, Standard Chartered also seeing some selling pressure. That's in line with what what we're seeing in banks in Europe as well today. Now, as mentioned just before the Bank of England decision came through, Switzerland's central bank cut its benchmark rate by 25 basis points, lowering it to 0.25%, a fifth consecutive cut. Carolyn spoke to the chairman, Martin Schlegel, and started by asking him why the S&P chose to cut, given other central banks have opted to remain steady.
So we decided today to lower interest rates from 0.5 to 0.25%. The reason is that we have a low inflation pressure in Switzerland, and also there are downside risks to inflation in Switzerland, and therefore we lowered the S&P policy rate today.
But it's quite interesting. The other central banks, many other central banks in the world, they're staying put. Why are you deciding to move ahead with the cut?
We do monetary policy for Switzerland, and we came to the conclusion that monetary conditions in Switzerland need this cut of 25 basis points to 25 basis points currently.
So you don't see any value in waiting to see how conditions will evolve?
So in monetary policy, if you see a need to act, you have to act early and decisively, and this is what the Swiss National Bank does. Because waiting does not add value. If you wait, then you have to react even more in the future.
Especially since you're only deciding on monetary policy every quarter, so that obviously separates you from other central banks. I want to talk to you about the likelihood of negative rates. This is something that the options market had priced in back in December for the end of this year. Now it's looking a little bit less likely. Is that still a tool that you're actively considering?
So in Switzerland, nobody likes negative interest rates. Also, the Swiss National Bank doesn't like negative interest rates. But I can assure you that we will not hesitate to use all the tools that we have in the toolbox to warrant price stability and to conduct our monetary policy.
Another very widely used tool by you in the past, of course, has been currency market intervention. Now, if we take a look at the data from 2024, it has almost ground to a halt. Are there political concerns about drawing the ire of Donald Trump if you return to this tool?
So we are ready to use all the tools that you have in the toolbox, be it on the interest rate side, but also on the exchange rate side. I can maybe also say that Switzerland is not a currency manipulator. When we used the FX interventions in the last decade, it was because inflation was clearly too low, so it was a tool to fulfill our mandate, which is price stability.
Can I ask you about your assessment of the level of the Swissy right now? Is it restrictive? Is it neutral? Is it too high? Where do you see it right now when it comes to the impact on the Swiss economy and the exporters?
So the Swiss National Bank looks at the monetary conditions, and we think that monetary conditions at the moment are appropriate.
When it comes to the Swissy, what's been quite interesting too is that over the past couple of weeks, even though there's been a lot of geopolitical turmoil, the safe haven flows into the currency have been almost non-existent. How do you explain this? Are you surprised by this as well?
So if you look at financial markets in general, there's not much risk actually priced in. So a lot of the risk markets, like equity markets and so on, have performed quite well over the last, would say, quarter. And this also means that the safe haven demand for Swiss franc was rather low in the last quarter.
Let me ask you about the resilience of the Swiss economy. Over the past few weeks, it's actually performed better than expected. The unemployment picture has improved, so has the growth picture. As some would even argue, you didn't even need the cut today. But of course, there's a lot of uncertainty on the horizon, specifically when it comes to tariffs. How resilient is a small, open economy to tariffs?
So Switzerland is a small open economy, as you mentioned, and a large part of the Swiss economy actually is exporters. This means that Switzerland is really needs open borders, needs free trade, and this means also that the exchange rate is also important, of course, for Switzerland.
Mm-hmm. But the resilience of the Swiss economy to tariffs, it obviously has been through that before. Are you optimistic that it can weather this as well if it comes around a second time?
This is actually a very complex question. It depends if you talk about direct effects or indirect effects. It also depends on the price setting power of individual firms. So it's almost impossible to do a precise forecast there.
Final question for me. During the press conference, there were actually quite a number of questions around this Mar-a-Lago Accord. Obviously, a lot of uncertainty attached to it as to whether it will actually be put in place, very complex. But how do your Treasury holdings look, and how are you looking to diversify that?
So Switzerland, the Swiss National Bank, has large FX reserves. And there we have set certain criteria to invest. One is, for example, liquidity, but also safety of the assets. And of course, U.S. Treasuries are an important part of FX reserves when it comes to liquidity and also safety.
Does that mean you're looking to diversify, even though it is incredibly important? But given the Mar-a-Lago Accord discussions, is there any thought about diversifying?
So we are very well diversified already. So 40% is US dollars, roughly 40%, a bit less, is in euros. Also, we are well diversified if it comes to bonds, for example. We have government bonds, we have corporate bonds, we also have equity. So diversification is really key for the Swiss National Bank. But regarding the Mar-a-Lago Accord, there's a lot of uncertainty still there, and I can assure you that we really follow this very closely.
So that was the chairman of the SNB speaking to Carolyn after its rate decision. Now back to the Bank of England, which just decided to keep rates unchanged at today's meeting. 4.5% is the level for the main bank rate. Sterling down about 0.25%. We were down more than 1/3% before the decision came through. So the sterling has pared back some of those earlier losses. 1.297 is the level. The vote was 8-1 to maintain rates. There was one dissenter who was looking to cut rates by 0.25%, Swati Dhingra. Trade policy has intensified. Other geopolitical uncertainties have also increased, the Bank of England has said. They note that the growth has been slightly stronger than expected in February, but surveys suggest weak growth and especially employment plans for the future. So monetary policy will need to continue to remain restrictive for sufficiently long. That's the language out of the MPC. And that is it for Decision Time. Thank you for tuning in. We'll hand you